How to beat a bear market. So the stock market seems as though it's been getting worse and worse and worse over the course of this year. There are ways that you can tread water and make sure that your investments don't go completely underwater. And there are ways that you can go on offense and aggressively attack a falling market. But just like with a real bear, you're going to want to go in prepared for mortal life or death combat, because bear markets can be deadly. Now that's exactly what I'm going to talk about in this video, after introductions of course. You're watching Finance Squared, and I'm your host, Derek West. On this channel, we love talking about all things personal finance, and surviving market downturns is definitely among those topics. What are your plans for weathering the upcoming bear market? Let us know in the comments down below. And be sure to lovingly, tenderly, gently smash that like button for the YouTube algorithm. So let's get into it, starting with what exactly is a bear market. Well, you hear the term all the time, particularly when markets start to go south. But that always begs the question, what do you mean when you say a bear market? Like, is it a market for bears? Is it a market for naked people? What is a bear market? A bear market is a market that's being eaten up by, I guess, negative news and downward momentum, if you will. You can identify a bear market by looking at prices of the market you're dealing with, and if those prices are going down 20% or more from their highs. That, my friends, is a bear market. For example, the most famous or infamous bear market in the history of the universe was the stock market starting on October 24th of 1929. By October 29th of 1929, the Dow Jones Industrial Average, or what would become the Dow Jones Industrial Average, had dropped by more than 30%, which is among the worst and fastest declines in U.S. history. The market that ensued did not return to its pre-crisis highs until November 23rd, 1954, or 25 years later, which is an indicator of how long it can be until a bear market regains its strength. To mix metaphors, the bear stock market of the Great Depression might be the most famous example, or infamous, but it's not the only one. For example, you have the Japanese Nikkei Index, which is an index of the Japanese stock market. The market began to shrink in September of 1992. Over the course of 4 years, it had fallen about 40% from its peak. As a matter of fact, to this day, it has not yet attained its pre-crisis highs. Again, another infamous stock market that we all are aware of is the U.S. stock market crash on Black Monday of October 19th, 1987. That crash measured a 28% loss in a single day. More recently, we have the U.S. stock market crash of spring 2020, which just happened to be the largest stock market crash since the Great Depression. From the market's peak on February 12th to its nadir on March 16th, the Dow Jones Industrial Average lost 9,362.90 points, which landed in a 31.7% market decline, which made it the closest bear market to our present day circumstances, which leaves us talking about today's market. Are we officially in a bear market or not? So, bearing in mind that most people define a bear market as a 20% loss in value of the market, who those people that define this are, media pundits and outlets and folks with academic and institutional influence in the marketplace. But if you think about it, whenever a market's sliding and there's just negative pessimism in a marketplace, that is technically a bear market. When there is exuberance in the marketplace and it just continues to rise and rise and rise, well, now you have a bull market. But again, most media outlets, pundits, and academics will tell you that a bear market is 20% of a loss from the highs of the market. So we use that as a rule of thumb. That means that depending on when you're watching this and how badly the market is going to be going, we're not yet in a bear market. But we have been trending in that direction pretty hard. And if that trend continues to bear out, we need to think about the tips and tricks for surviving that market. The one tip and trick that holds true for bear markets or for camping in the woods is to always be prepared. One thing that you should never forget is that you should not wait for a bear market to manifest itself before you start preparing for that bear market. If you begin preparing at the bear market when you start hearing about it in the news, you're likely at a point where it's too late. You see, when markets are hot and rising, that's when you should be preparing for the next crash. How would you prepare, you may ask? Well, you're going to want to have an emergency fund saved up and ready to go, just in case your job should disappear or you run into other financial hardship. Remember, that's what emergency funds are for. They're designed to help tide you over so you don't have to rely on credit cards or other forms of loans, or worse, like loan sharks, to keep you afloat when times are tough. But preparation also means being liquid in your portfolio to a certain extent. Don't be afraid to keep some cash in your portfolio specifically for bear markets. Well, why do I say that? Because some of the best investors out there give that same advice, from Warren Buffett to Ray Dalio, etc. And because it makes sense. Remember, a bear market typically means assets are on sale. And what that means is that there's a rational selling of typically pretty valuable company stocks. The reason being is that investors are just looking to get rid of these stocks because they're just a casualty of the overall market falling in value, a casualty of the market psychology, if you will. When that happens, that's the perfect time to use some of the liquidity you have built up to purchase those falling assets at rock bottom prices. Remember, quite a few fortunes are made during times of economic hardship. And that takes us to our next tip. You got to keep your dime in hands. What do I mean by that? Well, dime in hands is a funny term that people on the internet use to describe holding onto your investment no matter what. And that's true particularly if you're making value-based investments. For example, if you're invested in an IRA or a 401k and are consistently adding funds into that vehicle and you're keeping up the momentum when times get rough, well, you're in a good position then, particularly if you're invested in broad-based index funds or ETFs. Yes, it's going to appear as though, and it's going to be real actually, that when bear markets happen, the value of your index funds and ETFs and all of those things are going to go down in price, or in value rather. However, that's the beauty of ETFs and index funds, particularly broad-based index funds and ETFs. Sure, they may not be as profitable as buying single stocks or puts or options, things of that nature. But because they're so diversified, they tend to rise in value with time, particularly big swaths of time. We're talking about 5, 10, 15-year time periods. A lesson that many folks learned from the bear market 2007 to 2009 is that if you buy index funds at regular intervals, through a 401k, an IRA, etc., you will prosper when the market finally does rebound, particularly if you keep investing during that time period. Those who used this strategy didn't know whether the bear market would end in December 2007, June 2008, or when it finally actually did end in March 2009. But those investors that kept their dime in hands, their 401ks were probably cut in half by the time the bear market ended. But all of those shares that were bought on the way down became profitable when the market finally turned around and climbed higher. By 2015, those who hung in there had made enormous profits from the cheaper shares purchased during the downturn. And if they got company matching, all the better. So the moral of the story is it's best not to go all in at any one time, but to just keep investing small amounts at regular intervals and to not pull out when times get tough. So far, we've just talked about strategies that you would use if you want to be defensive with a bear market. You know, kind of like curling into a ball and playing dead. Not that there's anything wrong with that. There are strategies out there that will help an aggressive person make money during a bear market. For example, the put strategy. This is an advanced strategy that nevertheless has proven to work wonders for those with the know-how and the fortitude to pull it off. But if you feel that a bear market is developing and you have substantial long positions in the market, another useful strategy is to buy inexpensive short and long-term puts on major indices. Now I just threw out a big word there. Not really a big word, but maybe a confusing word for those of you that are not that experienced in the stock market. So just make sure we're on the same page. A long position is the typical position you take when you buy a stock. You're hoping when you buy a stock that its value increases over a long period of time. See what I did there? And that's the reason why many people refer to that as a long position. You can take long positions in stocks, real estate, crypto, etc. In fact, that's what most of us do when we buy any of those assets. Taking long and short positions really needs to be in its own separate video. So drop a comment down below if that's something you'd like to see, and make sure you're subscribed with post notifications turned on so you see it when it does drop. But keeping in mind that trading derivatives often comes with extra risk in the form of margin requirements. Margin requirements is basically borrowing money from an investment house so that you can trade on the stock market. And that may require special account privileges with your brokerage account. So this is not something that you can do just willy-nilly. This is something that you definitely have to put some thought into and plan ahead for. But now a put is an option that requires rights for 100 shares, let's say, and it has a fixed time length before it expires as worthless. Not to mention that it has a specified price for selling. If you buy puts on the Dow Jones Industrial Average, S&P 500, and NASDAQ, and the market declines, your puts will gain in value as these indexes are falling. Because options increase or decrease by a much larger percentage than stocks, even a smaller number of put contracts can offset your long stock position losses. As expiration is approaching, you have the option to sell your puts on the open market or exercise and give up the shares. Now this is a very risky strategy and it requires some experience before you try it for the first time. So definitely talk to your financial advisor or a professional stock trader before you try this out. But there are other ways that you can make money during bear markets. You see, investors tend to retreat to a handful of alternative investments and markets that are considered safe havens, quote unquote. Sometimes precious metals like gold and silver outperform the stock market when the stock market goes down. Food and personal care stocks, often called defensive stocks, they also perform pretty well when the stock market goes down. There are certain times when bonds go up as stocks decline. Sometimes a particular sector of the market, such as utilities, real estate, healthcare, well, they might do well even if other sectors are losing value. Now, one that I often hear come up is the crypto market. Now, it's a newer market that has not yet proven to have an anti-pattern when markets go down. In fact, in some cases, when stock markets go down, crypto markets go down as well. Now, as that market matures, that may not correlate so highly, but that's what I've seen so far. But that's why it pays to know the general landscape of the market and why investors are starting to pull back. For example, in our current context, there is justified fear that inflation will cause consumers to cut back on their spending, and that will have a twofold effect on the economy. Consumers cutting back their spending will decrease corporate profits, and inflation will cause the Fed to increase interest rates, also causing consumer spending to go down, which will in fact affect the bottom line of many corporations. So with those two things in mind, you have two places that you can explore. Inflation will cause commodities to rise, so you might want to buy yourself some of the more common commodities, including gold, silver, copper, etc. But others you might want to consider include lumber, oats, cocoa. All those things will increase in value as inflation increases. In addition to that, supply chain challenges will affect their values in a positive way. Your second play is to invest in defensive industries, including food markets, places like Target or Walmart, food producers, including General Mills, and other staples, including Procter & Gamble. Because no matter what happens, people need to eat, people need toilet paper, people need toothbrushes, things like that. And those companies tend to make those things. And as inflation goes up, the prices of things will go up, increasing the profitability of those companies, even as people buy less and less of those things. The most important thing to keep in mind with a bear market is to keep your head and do not act impulsively. If everyone is selling, look to buy, because not every stock is going to be a stinker. There are going to be some stocks that are going to go bankrupt during this time period, and they deserve to go bankrupt. But stocks and companies that have good fundamentals, they're also going to suffer in value. But that means you should be prepared to buy them up. Remember, a bear market is the best time to be contrarian because that's when the best bargains are available. So let us know in the comments down below what tactics you're going to be taking during this market downswing. We're all dying to know. And be sure to like this video if you like this video. Subscribe to this channel and turn on post notifications so you get all of our latest tips and tricks on personal finance when they drop. And be sure to share this video with your financially savvy friends, your financial advisor, heck, even the ones who just don't have a clue. And remember that a goal without a plan is a wish. A goal with a plan and no action, well, that's just a wish list. Take it easy, guys. I'll catch you in the next video. Peace.